Hello there, I'm Steve McClellan, the financial engineer, and every Monday we go live to help you grow, control, and keep your hard-earned money instead of giving away to taxes, fees, losses, and the unknown. And that's exactly what we're going to do here again today. We're going to show you the best way to buy a car right here in Canada. Now, we're going to show you several different ways to buy cars in the next 10 minutes or so. But make sure you stick around to the end because we're going to show why the best way isn't more popular here in Canada. When all the dust is settled and the smoke is cleared and this presentation is all said and done, it should be less than 10 minutes, you will learn the best way to buy your next vehicle. So here in Canada, there are generally 3 ways to get a vehicle that requires money. So I'm not talking about stealing or inheriting a vehicle, but the 3 ways for you to acquire your next vehicle that needs money. Listen, there's leasing, that's number 1, financing, and of course buying. Financing is like lending, buying is buying it out straight with cash. So what's the best way? Well, with leasing, generally the only one that benefits is the car dealership. Think about it. As soon as you drive that new car off the lot, what happens to the value of that vehicle? It goes down. And it goes way down. So the car dealership is really capturing that depreciation cost. You're giving them a monthly payment. You return the vehicle to them with lots of rules and regulations. So it's almost like new. They're capturing that depreciation cost and selling it elsewhere. Now, leasing might make sense if you're a business owner and you can write off a lot of those monthly payments. Or if you have a series of fleets of vehicles and you can't have that big down payment, you need a lease agreement, that might make sense. But more often than not, leasing, the only one that benefits is the car dealership, which leaves the 2 more popular ways, the financing or borrowing or buying out with cash. Now you can see this picture here. This is a picture of me and my wife with our newborn, Rowan. When she was pregnant with this big guy, I finally decided to get my first real vehicle, and you can see it's an F-150 back there. We spent $40,000 on it. I'm a recovering engineer, so I did all the spreadsheets and all the math. And what I didn't take into account was something very important, and I will share with you what I did and what we now do in the future. Because that little guy right there, the guy in the car seat, he's a big, strapping, strong guy. He's getting even better every day. That truck, I can tell you, that truck is rusted out. So if I could have done it again, one thing I would have done is bought slightly used, all right? Almost new, but not quite. They seem to have those warranties down to a science. Within 3 years, that truck start breaking down. And I know, I can hear all the comments about buying a Ford. Anyways, let's look at the 2 ways, either borrowing, aka financing, or buying a vehicle. Which is the best? What do you think it's going to be? Well, most will borrow. And as I mentioned, my truck costs $40,000. So let's assume that you have $40,000 that you borrow from the bank or from the car dealership. They were nice enough to give you the $40,000, which you pay back over time plus interest. But is that the only vehicle you'll ever get? If you're like most Canadians, you're going to get anywhere from 8 to 10 vehicles. And again, think about it. They were nice enough, once you were approved, to give you the $40,000, which you paid back plus interest. But where did the bank or the lender get the money for the 2nd, 3rd, 8th, or 10th car? If you really think about it, they got it from you. This is a rinse and repeat cycle. They're making money hand over fist. In fact, most car dealerships don't make a lot of money from the sale of the vehicle. They make more from the financing. So that's another thing. When I bought the truck, we signed a leasing deal or a financing deal where we paid it back 1 month. They're getting wise to this, so a lot of times now you got to wait 6 months, but you can save a lot of money, pay the car for 6 months, and then pay it down. All right. So a lot of times we said instead of relying on the banks, you can become your own bank. But what about saving? Now, I'm a saver. And again, I did the math and calculations. You should have seen the beautiful spreadsheet I had as an engineer. And I determined the best way to buy a vehicle was with cash at the time. What I did not take into account was the opportunity cost of that $40,000. When I gave that $40,000 to the car dealership, they gave me a new truck, but that $40,000 no longer worked for me, no longer earned interest or dividends. It left me never to come back again. That $40,000 over time could have turned into $250,000 quite easily. And when Will Moran showed me this illustration of where the saver and the debtor end up, look where they end up. They end up at the exact same spot. This was a wake-up call for me. So one of the more popular ways, well, it's not that popular, to tell you the truth. Very few do it. What we try to help people do is act like the saver at first and then borrow against themselves. So this is where you act like the saver. You have the patience and the tenacity to save. And generally, we'd recommend putting it into a properly designed whole life policy that pays a dividend every year. That grows. And then you borrow from yourself. What's nice is that capital continues to grow. It does not become interrupted. It doesn't leave you. It continues to grow. We recommend that you usually pay yourself back like a car payment, as you can see in this illustration. And also, you can see there's a huge difference between the banker versus the debtor or the saver. This is often referred to as the infinite banking concept, where you become your own banker. You act like the saver at first. You put your money into a properly designed whole life policy, which eventually grows, and then over time you borrow against it and pay yourself back and rinse and repeat. Again, you can see the huge difference between the banker versus the debtor and the saver. So the question is, if this is the best way to buy a vehicle, and again, I usually recommend buying slightly used, 1 or 2 years is the best option to get. Why isn't more people using the infinite banking concept or borrowing from themselves? That's a great question. And there are several answers to that question. The first and foremost is, where do you think most Canadians get their financial guidance or advice from? Unfortunately, the majority still get their guidance and advice from the banks. And think about it. Where do the banks make most of their profits from? They make it from debt. They make it from credit cards, lines of credit, mortgages. The majority of Canadians are taking their financial guidance from an institution that wants you to be a consumer, that wants you to go in debt. I find this crazy. They will never talk about insurance that requires underwriting, like a whole life policy, unless you have approximately $5 million in the bank, and then they will call this private banking. But what about the traditional advisor out there? Well, again, there are a lot of great people in the financial industry, but the majority of them either lack knowledge or integrity. And I would say the majority lack knowledge. And it's just the way that the institution is set up. Financial advisors are compensated to sell lots of insurance and lots of mutual funds. Doing the right thing is not always rewarded. The other thing with the financial industry, it is very male dominated. And a lot of those males have big egos. And this goes on both sides of the spectrum. I mentioned the infinite banking concept. There are advisors out there that think the infinite banking concept is the end-all, be-all, and everyone that's not doing it is foolish. Where there's the other advisors who feel if they're not doing it my way or his or her way, that they're doing it wrong. And instead of collaborating, a lot of times these people compete against one another and often attack one another. So a lot of people keep their knowledge inside and not shared to the public. Hopefully we can change that someday soon. I'm a big fan of Warren Buffett. He says do not put all your eggs in one basket. He's a big fan of diversification, and so am I. Diversification, folks, does not mean owning a bunch of stocks or mutual funds. That is only one form of investing, and that's investing inside the stock market. Generally, a diversified portfolio has several ways of creating wealth, and as you can see from the list, business or your source of employment is a huge wealth creation. Real estate, living benefits, especially for business owners. This just means if anything ever happens to you, you still have income coming in. Investing and saving, this is what gets all the news and the glory. Very emotional, up and down. Whole life, that's where I become the expert in. And listen, it's a properly designed whole life policy. That's another reason why this concept of buying your next car isn't as popular, is because a lot of times people don't take the time to figure out how to design the whole life policy properly. Not all whole life policies are created equal. And then there's the alternatives such as cryptocurrency, other currencies, precious metals, private equity, hedge funds, the list goes on. Out of this diversified portfolio, folks, where do you think you're going to make most of your money? I hope after watching me, you realize that you are your number one asset. It's your business. It is your career that's going to create the most wealth. When you realize this, you need to start acting like you are your number one asset and go from good to great. Everything else just helps you grow that wealth. Whole life, though, when it's properly designed, is the only one that doesn't go down in value. It grows very tax efficiently, regardless of what happens in the economy or the market. To me, this is a picture that represents both the negatives and positives of a properly designed whole life policy. As you can see, growth is slow at first. To some, it's boring. They're wondering why they're doing this. But eventually, it becomes very efficient, almost exponential, and very exciting. I look at this whole life policy as one of the best ways to get a return on your hard-earned dollars with the lowest amount of risk out there. You have several different ways to get to your destination. The majority of advisors out there are going to tell you to put your money into the stock market, which historic returns show there is positive gains, as you can see on this chart right here. But let me ask you this. When do you think most people sell, and when do you think most people buy, including the biased Canadian investor or advisor? Let me tell you, it's the opposite of when they should. A properly designed whole life policy can help you get to your destination. Maybe not as exciting, but it can also help you get beyond that destination as well. There's more than one way to peel a potato, folks. If you have any questions or if you'd like to learn more, feel free to reach out. My website, designeanevenbetterfuture.com, and we'll be happy to help you grow, control, and keep your hard-earned money instead of giving away to taxes, fees, losses, and the unknown. Until then, be healthy, be wealthy, be wise, push through the noise.